Welcome back to Investing Talk podcast. We are so glad you're joining us today. We've been hearing a lot of buzz, especially over on social media about one particular company that's been on a pretty wild ride lately, Opendoor Technologies. So our mission today is to kind of unpack its story, peel back the layers a bit, and tackle that big question lots of people are asking, is Opendoor a good time to buy right now? We'll be pulling insights from the latest market reports and some pretty in-depth investment analyses to try and give you the clearest picture we can. Before we really dig into this, though, if you're finding value in these discussions, please do hit that subscribe button, maybe give us a like, and leave a comment with your thoughts. It really does help us out. And hey, if there's a specific company you'd like us to analyze in a future talk, just drop its name in a comment below after we wrap this one up. You can also consider buying us a coffee. Every little bit helps us keep bringing you these kinds of analyses. Okay, let's get into it. Opendoor, definitely a hot topic. We've seen its stock just surge amid what everyone's calling a meme stock rally. What's kind of striking here is that this big jump, it hasn't really been driven by any major company-specific news, has it? So what exactly is going on? How much of this is, market dynamics versus actual changes in how the company's doing?
Yeah, what's fascinating really is how clearly this recent surge in Opendoor stock, particularly around, say, July 17th, 2025, it just aligns perfectly with that broader meme stock rally phenomenon. This momentum, it's heavily fueled by retail investor sentiment. You see the chatter just absolutely exploding on platforms like X and Reddit. We're seeing loads of discussions drawing parallels between Opendoor and companies like Carvana, you remember, which also had that incredible sort of narrative-driven stock resurgence.
So it sounds like it's less about, the company's P&L sheet and more about this collective enthusiasm, like a wave of optimism pushing the price.
That's spot on, exactly. The recent gains seem largely decoupled from its actual operational performance. I mean, shares have surged almost threefold recently. It's basically re-entered the market as, well, a highly speculative play among retail traders. Those viral posts, especially from communities like Reddit's Wall Street Bets, they really highlighted this dramatic shift, didn't they? Focusing on the potential for Opendoor's recovery, not so much its current state.
Okay. And when we talk about recovery, that word itself implies, well, a challenging past, right? This isn't Opendoor's first time dealing with extreme volatility, is it? We've definitely seen its shares fall pretty hard before, down into what most people would call penny stock territory.
Oh, absolutely. And this raises a really important point about its history. Opendoor has had a, let's say, volatile journey since it went public through that SPAC merger back in 2020. They've faced big challenges like, cooling housing markets, significant inventory write-downs. Those have really hammered its performance. In fact, the company still hasn't posted an annual profit since going public. And just a couple of months ago, there were real concerns about potential delisting because the stock was stuck under $1 for so long.
Wow, delisting? Okay. And how are they planning to tackle that specific concern to get the share price back up?
Well, they've taken action. The company scheduled a special meeting, specifically to get shareholder approval for a reverse stock split. The idea there is to consolidate shares, which mechanically boosts the share price above that critical $1 threshold to avoid getting kicked off the exchange.
Right. It changes the price per share, but not the company's overall value.
Exactly. It's more of a cosmetic fix, but necessary in that situation.
Okay, so despite this, let's call it rocky history and the very speculative nature of this current rally, there are some quite vocal advocates seeing real potential, aren't there? Eric Jackson from EMJ Capital, for instance, he seems pretty bullish. What's his case?
Right, this enthusiasm isn't just random, is it? You can trace a lot of the renewed buzz back to influential voices like Eric Jackson. He's got a track record, known for some successful past picks, and he laid out his case for Opendoor in quite a detailed post on X. He set a pretty ambitious price target, and he talked about the potential for a substantial turnaround.
And what's driving his argument mainly?
His points largely center on the company's pretty aggressive cost-cutting measures, which he believes are making their iBuying model more efficient now. And also their leadership position, they're still a big player in that online home flipping market. He basically sees them as having survived the worst and now maybe poised for a rebound.
Interesting. And beyond just him, are there other sort of market mechanics at play? Things that could add more fuel to this fire, even just short term?
Oh, definitely. Opendoor currently has high levels of short interest. That means a lot of people are betting against the stock. Now, this creates the classic conditions for what's known as a short squeeze.
Right, where the short sellers have to buy back shares quickly if the price goes up.
Exactly. If the stock price moves up, even a bit, those short sellers might panic and rush to buy shares to cover their positions and limit losses. That forced buying can create a powerful, though often temporary, upward spiral in the price. For a stock like Opendoor, with its history, the volatility, and the strong retail interest, it's a very real possibility. It could potentially overshadow the fundamentals for a while.
Huh. Like a self-feeding loop, almost. Okay, what about concrete events? Anything coming up on the calendar that could act as a catalyst, something we should watch?
Yeah, the most immediate thing is their upcoming earnings report. That's scheduled for August 5th, 2025. That report should give us some much-needed clarity on their financial health. Are those cost cuts actually working? What are their prospects looking like?
Okay, so earnings are key. Anything else?
Well, longer term, broader factors like, say, the housing market stabilizing or even starting to recover,
Mm-hmm.
that could help. Or maybe significant policy changes that affect real estate financing. But those are bigger picture, less immediate things.
Got it. Okay, so we've covered the social media angle, the history, potential catalysts, but let's try to strip away the noise for a second. Let's look at the nuts and bolts. What do the actual numbers tell us about Opendoor's health? What are the fundamentals really saying?
All right, let's look at that. Fundamentally, Opendoor reported about $5.13 billion in trailing 12 months revenue, TTM, just the last full year. So that indicates a pretty substantial business scale, right? They're moving a lot of houses in the residential real estate tech space.
5 billion is significant revenue. Yeah.
It is. However, they also reported a net loss of $368 million TTM, and that translates to negative earnings per share, or EPS, of minus 52 cents. So that clearly highlights these ongoing profitability challenges. Despite the big revenue number, they just haven't cracked the code on making consistent profit yet.
And these profitability issues, how does that play into their overall financial structure? What about debt?
That's another key point. The company carries significant debt, and when you combine that debt with those low, or in this case, negative margins, well, it certainly makes their financial structure a point of concern. High debt makes any company more vulnerable, right?
Mm-hmm. Especially if rates go up or sales slow down.
Precisely. Now, when we talk valuation, the usual PE ratio, price to earnings, it isn't applicable here because, well, they're losing money. You can't really use it. But we can look at the price to sales ratio, the PS. That compares its market value to its annual sales. Based on a market cap around $1.2 billion and that $5.13 billion revenue, their PS ratio is roughly 0.23.
0.23. That sounds incredibly low.
It is extremely low. It means the market values the entire company at just a tiny fraction, like 23% of its annual sales. Now, that could suggest deep undervaluation to some people, or it could be a clear signal that the market is just really skeptical about whether they can ever turn those sales into actual profits. It's a big question mark.
Okay, that makes sense. So switching gears to the technical side, what's the recent price chart telling us? You mentioned volatility.
Oh, yeah. Volatility is definitely the word. It's high, with a beta around 2.68.
Wow, nearly 2.7.
Yeah. Beta measures how much a stock tends to move compared to the overall market. So a beta like that means Opendoor tends to swing almost 3 times as much as the S&P 500, for example. It's a roller coaster. The stock's been trading recently near $1.65. The 52-week range is pretty wide, from about 50 cents up to just over $3.
Big swings.
Huge swings. Now, its current price is actually above both its 50-day simple moving average, the SMA, which is around 69 cents, and its 200-day SMA, the longer-term trend line, which is about $1.31.
Okay, so above key moving averages, that's usually seen as positive, short term.
Typically, yes. It often indicates some short-term strength or upward momentum. And the 14-day RSI, the relative strength index, that's sitting around 52.68.
So pretty neutral territory there, not overbought or oversold.
Exactly. RSI around 50 is considered neutral, so it suggests the momentum is kind of balanced right now, not extremely pushed in either direction the very immediate term. And yes, there is a short-term uptrend happening. They've had 19 green days, meaning days the price closed higher, in the last 30 trading days.
Okay, so technicals show some recent strength, maybe an uptrend, but overlaid with extreme volatility. How does that square with Wall Street sentiment versus, the Reddit crowd?
Yeah, that's a really important contrast. Wall Street analysts, generally speaking, they maintain an overall hold rating on the stock. The price targets are pretty modest, clustering around the current price, maybe $1.70 or so.
Yeah.
This suggests they're cautious, right? They aren't seeing huge upside based just on the fundamentals right now.
So Wall Street's lukewarm.
pretty much. Social sentiment, though, that's where you see the cautious bullishness, definitely fueled by that meme stock energy we talked about. But it's worth noting, the broader market's fear and greed index is currently at 39. That signals fear among general investors, indicating maybe a risk-off mood overall. What's really crucial for listeners to grasp here is the significant risk profile. You've got the high debt, the consistent losses, plus the whole residential real estate sector is super sensitive to interest rates, economic cycles. If housing demand faces headwinds, Opendoor feels it. Add in macro risks like inflation, maybe more rate hikes, and that high beta, those wide price swings, it all poses significant risks, especially for anyone who's risk-averse. This is not a sleep-well-at-night stock for most.
Okay, so after looking at all of this, the meme factor, the history, the fundamentals, the technicals, the risks, where do we land? What's our overall suitability rating for Opendoor right now? And maybe more importantly, who is this actually for? Who might this be suitable investment for, if anyone?
All right, pulling it all together, our analysis puts Opendoor's overall suitability rating at a 5 out of 10, right in the middle.
Okay, a 5. How does that break down?
Well, we rated its fundamental strength a 4 out of 10. That's because, yes, high revenue, but the ongoing losses and debt are serious drags. Its valuation gets a 6 out of 10. That really low PS ratio suggests it could be a discount if things turn around. Big if. And its technical outlook also gets a 6 out of 10. There's that short-term bullish momentum, but it's extremely volatile. But then its risk profile, that's a low 3 out of 10. The high debt, the sector cyclicality, the macro risks, it's just a very risky proposition overall.
So a 5 overall, kind of balance between potential and risk.
Exactly. It makes Opendoor a highly speculative opportunity. There's potential for a turnaround, absolutely, but it comes with a lot of warnings attached for, say, short-term traders. The recent momentum and that crazy volatility might make it interesting, but it absolutely demands tight risk management. You need to be ready to cut losses very quickly.
Not for the faint of heart.
Definitely not. And for long-term investors, it would require really strong conviction. Conviction in a substantial turnaround in the company's actual profitability and a recovery in the housing market. As it stands now, it's just very speculative and very, very risky for a long-term hold based on current information.
Okay, so for those listeners who hear all this, understand the risks, but are still considering maybe taking a speculative position, what might be a reasonable entry point? And crucially, how should they think about managing that risk, like setting stops?
Right. For those willing to take on that significant risk, looking at the current chart and forecasts, maybe an entry somewhere between $1.50 and $1.80 could be considered.
Yeah.
But, and this is critical, we'd strongly suggest setting a stop-loss order around $1.30.
Why $1.30 specifically?
That level is just below some recent price support, and importantly, it's right around that 200-day moving average we mentioned. Falling below that would be a pretty negative technical signal. It's your safety net, basically.
A lot of line in the sand. And on the upside, any targets?
For a take-profit target, well, based on some analysts' upside projections, initial estimates might fall in the range of, say, $5 to $6.50. But, and I have to stress this again, extreme caution is warranted. Given the volatility, the fundamental challenges, these targets are highly speculative. This is not a stock you just buy and forget about right now.
No, definitely sounds like one you need to watch closely if you're involved. This whole look at Opendoor, it really highlights this complex dance, doesn't it? Between market sentiment, sometimes fleeting sentiment, the underlying company fundamentals, and these bigger economic forces. It shows it's not just about what a company does, but how the market perceives it, and how powerful a narrative, especially one born on social media, can be in driving price, at least for a time.
It really does. And it raises, I think, a really important question for all investors today. In this era where social media can just ignite these massive rallies, even in companies with pretty shaky fundamentals, how do you, as an investor, actually separate the genuine hype, maybe justified hype, from just noise? How do you find the true long-term value? And maybe what lessons can we specifically take from Opendoor's recent journey about managing risk when you're looking at these highly speculative plays?
Exactly. Definitely something for all of you out there to consider as you navigate your own investing journey. Thank you so much for joining us for this analysis today. Remember to subscribe, like, comment, let us know what you think, or suggest another company, and maybe consider buying us that coffee. We'll be back soon with another look at the markets. Until then, stay informed and invest wisely.